When we're looking at the 5's, 10's predictor, what we're trying to do is we're trying to predict, interestingly enough, what the 5's, 10's are going to do. And the way we do that is to find two markets that give us some pointers. The two markets that give us pointers, of course, is comparing the ZF to the ZN, because the difference between the ZF and the ZN is what? The 5's, 10's. Now, why do we want to know what the 5's, 10's are going to be doing in the first place? Well, if we know what the 5's, 10's are going to be doing, 95 times out of 100, we know exactly what bonds are going to be doing. So when we think about this idea of a positive, highly correlated positive product like these, this is a great starting point. Now, when we come to do things like bonds, when we come to this concept and this process, it's very, very easy to start the process out. We start out with a brand new chart. And when we start out with a brand new chart, we're obviously going to be starting to build a narrative. We've got to try and start building a narrative from something. So let's just do that. And the chart I'm going to build is an inverse knob spread. Let me say, why an inverse knob spread? It's just so that we can add and subtract at the ZB contract out of this, okay? So this is an inverse knob spread, okay? Nice and easy to understand. It's just a knob spread. Now, you might say, but this doesn't tell me much about bonds. Well, it tells you an awful lot about bonds, actually. But yeah, I can accept that sometimes bonds are positive and sometimes negatively correlated to this, but you're way ahead of where we should be, okay? If this is the knob spread inverted, it's a 1 by 3. What I've got to try and do now is I'm going to try and construct a FOB spread. FOB is the 5's, 30's. And to construct a FOB spread, all we have to now do is type in ZB1 minus the ZF1 times 4. And this is now the FOB spread. Now, you might be saying, well, I don't quite understand why this gives us any value at all. Well, what I'm going to do is I'm going to change the candlestick to a line because it's easier to see it as a line. This is the kind of chart you should be dreaming of as a trader. Now, I don't know if you all agree with me on that, but this is the kind of chart as a trader. As an index arbitrage trader, I dream of in my, and you know, in the deepest of nights, you think this is perfection. This is the Jennifer Lawrence of trading, isn't it? This is exactly what you're trying to see. This is the kind of outcomes that really, really should make you an awful lot of money. Now, I don't know if you can see it or not, but I can see it as a bond trader. I can see it as a bond trader. Now, one of the things you'll be able to recognize as a trader is that they're very strongly correlated. That's the main point to this whole process. They are very strongly correlated, and if they're very, very strongly correlated, as a trader, this is what I'm looking for all the time. I'm looking for this relationship. And if we zoom out, we can see this relationship is constant, it's regular all the way through this process. And you say, but which one leads? This is where I always struggle. Which one leads? It seems as if the orange always seems to lead, and there is a certain element of truth because there's more curve to the orange, of course. So in other words, if there's more curve to the orange should lead, but it doesn't always lead, and that's one of the challenges. And you can see quite clearly that as the orange starts to lead higher here, the bottom edge buy on the bond seems to be this great trade opportunity here. This seems to be where the business end is going to take place. And obviously, as the orange starts to diverge, as we get a higher high on the blue line, as we get a higher high on the knob spread, it seems to be that that's a great sellable higher high phase there, and another great sell. And as this divergence takes place, again, another opportunity to trade the knob spread. Now, these are great opportunities to trade the knob spread, but you don't trade the knob spread. But the knob spread begets the grail, doesn't it? The knob spread gets the grail trade. So if we know where the knob spread is going, we can start to figure out roughly where the grail spread is going. Now for banks, it's not actually about necessarily trading the knob spread, although we can do it. What happens is you leg into the knob spread and you then leg into the FOB spread, and then you leg out of the FOB spread, and then you leg out of the knob spread, and so on and so on. So you can obviously recognize that somebody was legging into the FOB spread early and then they started to buy the grail version of the FOB spread, knob spread at the lower lows here. So there's a grail aspect of this curve trade versus curve trade, correct? Does everybody recognize that that's the case? Why does it happen? Because it works its way from the front end of the curve to the back end of the curve. Now, it doesn't always work its way from the front end to the back end. Sometimes it works from the back end to the front end. And that's when we start to see that the knob spread starts to lead the process. And that's when everybody gets into a little bit of a pickle. However, the banks don't get into pickles. Because what happens for the banks is that they're not buying the blue line because the orange line's been bought. They start selling the fight. And we say, why would they be selling the fight? Well, if we go through the calculation on this trade, very, very simple. It's not exactly the fight, but it gives you a rough idea of what we're talking about here. The blue line is, of course, if we're buying the blue line, we're buying the ZB contract. If we're buying the blue line, we're selling the ZN contract, okay? So that's what we're doing if we're buying the blue line. Buying ZBs, selling ZNs. Does everybody see that, and does everybody understand it? Now, what if we're selling the orange line? We're selling ZB and we're buying ZF. Okay? We're selling ZB and we're buying ZF if we're selling into this orange line here. And we can start to recognize lots of elements that go to making up a bit of a spread trade narrative. We can start to recognize the opportunities to do business in these areas. Now, where does that take us to? Well, it always relies on us going back to the idea of what happens inside the world of spread trading. There's the grail trade opportunities. Now, as I said, you might never have any desire to trade the knob spread, and that's a pity because it's one of the easier trades that you can ever do. And the big challenge we have with bonds is that the bond doesn't go up or down regularly because the knob spread goes up or down. Of course, that's something, again, that we can recognize and we can understand as normal. That's something that we can simply look at and say, no, that just isn't the right trade. It's the wrong way around. It doesn't make any sense because sometimes we get bull steepeners and sometimes we get bull flatteners on the knob spread, as you know, because we get parallel shifts and we get curve twists. So when we start to think about this and we think about it through, we start to recognize where the bond opportunity is. So let's just go back now to the spreads. This is a 5's, 10's predictor. The ZBZF is the blue, and the ZBZN is the purple. Now, when I see this, I can start recognizing what the ZFZN is going to be. So I can start recognizing straight away that if I'm selling up here, if I sell up at the top edge here, what is this trade here? If I sell into the top edge here, what is this trade? Selling ZB, buying ZF. And obviously, if I'm going to be selling ZB and buying ZF, I'm going to be buying the 5-year. I'm going to be buying the 5's, 10's for a steepener. Buying the 5's, 10's for a steepener. So when I see this opportunity here, and I start saying to myself, that looks like an opportunity to trade. Now, as I said, what you're normally seeing is you're seeing this accelerating. What most curve traders are doing are they are buying the knob spread into that rally. When the knob spread is now overbought, you're starting to recognize that situation. But obviously, when the FOB spread and the knob spread are diverging, you're starting to recognize the opposite. So it is a process that you have to understand as a process. If you don't understand the process of 5's, 30's, 10's, 30's, you're not going to really understand the process of where the buy on bonds really is. It's a little bit more complicated than simply recognizing this divergence. But anyway, we can come back to this as a subject in its own right. So if I'm selling the blue line, I'm buying the purple. If I'm selling the blue line and buying the purple, I'm buying the fight. So if I'm selling the blue line and buying the purple, I'm buying the fight, which is the black line at the bottom edge. The black line should be diverging negatively from this, and there should be some sort of divergence creeping into this, into the purple line and into the blue line to tell me that the 5's, 10's is the right bottom edge, or the 5's, 10's needs to be at accelerated levels which would obviously be the gap between the purple line and the blue line as an accelerated level, of course. So the more acceleration we get in this, the lower the black line is going to be, and that gives us a better, cleaner opportunity to buy the fight. You can see what happened to the fight. We had this big upside rally on the fight. The good news is that when we see this, so for example, you can see here up here, you can see there was a very big opportunity to buy the fight into the lows again. Big value divergences in the background. The fight rallied, but it rallied in the background of these other markets flattening out a little bit. So there is a little bit more complication to this than perhaps initially meets the eye. But if you can master this process, the fight, as a rule, gives us discounts and premiums to duration in terms of bond trades. In other words, if I know I'm going to be buying the fight, I know I'm going to be selling the bond. So if I look at the fight against the bond, we normally see it as a very strong negative correlation. So when I put this on the charts and you start looking for that strong negative correlation, you can see obviously that if I'm buying the fight in here, I should be able to make money by selling bonds. Well, the bond price collapsed beautifully. If I start looking into this phase here and I start thinking to myself I should be buying, selling the fight at the top edge, I should be able to make money by buying bonds, and we got a big rally on bonds this morning through to the top line prices. So it is very, very useful to be able to master this as a skill. Very, very important actually for bond traders to master this as a skill, because guess what we can do with this? We can do this on every single pairs trade. We can do this with every single pairs trade that we make. Every single pairs trade is an opportunity, because if I trade the 2's 5's and the 5's 10's, I can obviously look at that as a relationship. If I trade the 2's 10's and the 2's 5's, I can see the difference as the 5's 10's. If I trade the 5's 10's and the 5's 30's, I can see the difference. I can see the difference. I can build these storylines on every single chart that I've got in treasuries. The tighter it is to a positive correlation, the better the opportunity for me to see it as a correlation, the better the opportunity for me to see it as a statistical arbitrage trader, and the better the opportunity for me to make some very, very easy money based on stat arb opportunities. So when we start going back to these ideas, the idea of building stories around this, the idea of building the ZF, ZNs, and the idea of building the 5's 10's, or building the 10's 30's, for example. So we started out talking about this, and then we've got the 10's 30's here. If I look at the 10's 30's, I could say, well, how could you build the 10's 30's? Well, I could build the 5's 30's, and I could build the 10's 30's. So if I built the 5's 30's and the 10's 30's, obviously the difference between them is the 5's 10's. So we can start to recognize the idea is, if you've got two things that have the same component piece, then you can make sense of what the third piece is always up, because everything works in triangles in the world of spreads, doesn't it? The 5's 10's and the 5's 30's means that the 10's is obviously the isolated piece in the middle, and we can start to recognize the difference between the two. The standard is the 5's. The 5's is obviously the market that is exposed. The 5 is the market that is not part of that combination. The 30's is. So we can start to recognize the value by simply looking at these spreads and saying, right, number one, what is the spread? How big is the spread differential? And number two, where's the trade? How big is the spread differential? Number two, where's the trade? Number three, of course, is what direction is that differential trading in? If the knob spread is rising or if the knob spread is falling. If there's a divergent high or a divergent low in the knob spread or the FOB spread, what does that mean? What does it normally mean? What's average? And this is what we can make sense of, isn't it? We can make sense of these simple key elements when we're looking at the FOBs and the knobs and everything else. So some fantastic opportunities to trade these ideas. And as a bond trader, I hope that you just put it on your charts, play about with it until you understand it. Think about it. Think about how strong a positive correlation it is. And it's very easy to do these correlation coefficients, by the way, guys, because if I look at this, go back to this chart again here for a second, and you might be saying, yeah, but how do I know that this is a relationship that I want to analyze? Well, it's very, very interesting, because if we go into indicators and we go into correlation coefficients, and we come up with a correlation I keep doing that. Sorry, guys. If you come up with correlation coefficients, what you put in this box here is, of course, the ZB, ZN, ZB1. Okay, I've got the ZN, so it's ZB1 minus ZF1. So when we put that relationship in, of course, this should show as almost 1.0, shouldn't it? If we've done it right, this should show as almost 1.0. And if we scroll out on the charts, you can see it's nearly always 1.0. It's nearly always right along that top line print. In other words, the bank's going to get involved where you see the white balance areas, isn't it? Understand that? So where you see these white balance areas, when you start to recognize the p-values, for example, in these areas starting to increase, when you start to recognize these as opportunities, when you start to recognize the p-value in these areas as big opportunities, you're going to start to recognize that this is very, very useful stuff in here. The bigger the value divergence, the bigger the bank trade. So there's going to be a very, very big bank trade here, isn't there? A very big bank trade opportunity here. Now, the bank trade opportunity isn't necessarily in the bond, but it's possibly going to be in the bond, isn't it? So when you see that huge bank trade opportunity there, there's another huge bank opportunity to make easy arbitrage money here, and there's another opportunity for the bank to make easy arbitrage money here. You start to recognize that the bank's got it easy. You may say, well, how's the bank got it easy? Because they're obviously trading the spread divergences in these areas. When these divergences creep in, they're obviously very, very excited about trying to take advantage of any of these divergent stories. You can see the drive lower, for example, here on the knob spread starts to create a divergent opportunity into this lower print. You can see that drive higher on the knob spread starts to create that divergent opportunity. Now this is a little bit slow to see it, but I'll speed it up a little bit, and you'll see it inside the size of these storylines. As we start to move the needle across a little bit, you'll start to recognize that the spread starts to widen on some of these ideas. If we start shortening some of the duration on some of these processes, you can start to look back at some of these ideas as they evolve, and obviously some of them become bigger and some of them become smaller because you've taken in too much of a correlation, or you've not got enough correlation. Sometimes you have to take it in the opposite direction to bring in the bigger correlations that are starting to set out. It doesn't make any difference so long as you understand what it is you're looking at. So you can see this top edge up here is very clearly gone into the white zone here. And obviously that tells you that the bank is going to be busy with this. The bank is going to be busy. When that correlation starts breaking hard here, you say, right, sell the blue line, buy the orange line, and I'll make money. And a lot of people look at that and say, how did the bank make money on that trade? It doesn't go very far. But look at the blue line. Let's imagine, for example, that the orange line had just went to break even. The orange line went to break even here. Look at the money that the bank made by selling the blue line. At the same point as that goes to break even, look at how much money the bank made selling the blue line. That is almost an arbitrage. It's not quite an arbitrage because you're doing two different things, but you're comparing two assets from the same asset class, which is treasuries. You're just trading a durational pop here, aren't you? So if we're trading a durational pop on this, it makes sense that the bank is going to be able to take these two trades at the same time and pretty much guarantee that they're going to make money. The bank loves guarantees that they're going to make money. It's one of the bank's passions, of course. Max has just bought some bottom edge S&P at 45.73, just so you know. 45.73. Max sold some S&P at 45.83, just bought back at 45.73. You can see there's Max's trades. Max bought the bottom edge here at 76.5, sold the top edge here at 83s, just bought into the bottom edge there at 73s. So Max picking up the buys, the sells, and the buys at the moment on these short-term swing opportunities just now on the S&P. So doing some pretty good business so far, Max, especially in a market that has the volatility we're seeing today. So doing a pretty good job. Doing a pretty good job of it. So Max on top of the trade, doing what it's supposed to be doing, making some monies. There's the buy trade kicking off, guys. Max right on point again, wasn't it? Max right on point. It's almost as soon as we tell everybody Max has been buying into the bottom edge, everybody piles in and the price just goes straight up. That was nice. Get some money on that.
And just like that, to the moon.
Well, not just yet. Max is on offer watch on the uptick into the 81s there, Kim. Max flipped it into offer watch at 81s, but didn't get a trigger for the sell.
But he did pick up a good price. That Max is a handy assistant. Look at that, it's turning over. Good place to have taken some profits then at 81.